Here's the thing. First Street says up to $1.47 trillion in property value could erode over 30 years. Let that sink in. While the public fights about transparency, lenders are building their own red zones with per-property climate diagnostics. I'll show you why agents pushed back on broad risk scores, what lenders use instead, and how rising insurance costs and non-renewals in high-risk areas may change who gets a mortgage in 2026. If you think your neighborhood is safe because the listing looks clean, you're not ready for the lender's map. Before we move on, please take a moment to subscribe to the channel and like the video. So, here's the quiet bomb. Late 2025, the biggest home site pulled those flood, fire, and heat badges off listings, kept a tiny link to the source, and called it transparency. Buyers were hunting for clarity and got a scavenger hunt. Let that sink in. Timeline, fast. End of November, those color-coded risk scores vanish from the listing pages. Agents had been torching them in meetings and message boards, saying deals died at first glance. Zillow leaves a tucked-away link to First Street data, not front and center, while the comments go feral. Threads filled up with people accusing the models of spooking buyers and others yelling back that hiding risk equals selling lemons. It wasn't subtle. Here's the tension nobody wants to own. Agents in Florida and California said those scores nuked offers, not because every house was doomed, but because the red splash treated entire blocks the same. One-click panic. A buyer sees a crimson tag and ghosts a whole zip code like it's cursed. Meanwhile, the nuance lives in the crawl space and roof deck, and no one scrolling on a phone is parsing that. Macro map versus micro parcel. A canal front place in Miami isn't the same story as the house across the street with a raised slab, flood vents, and storm shutters that actually close. One sits below the base flood elevation and eats water on king tides. The other rides higher and has a roof tie-down system that a wind model actually respects. Same block, completely different expected losses. But those broad scores didn't speak that language. MLS groups pushed back, saying the public models weren't granular enough at the lot level. Driveways sloped the wrong way, foundation height ignored, fire egress not counted. That matters when embers hop a ridge or when a storm surge slips up a canal behind your fence line. First Street fired back that burying this data means buyers walk straight into future liabilities. That quote stung because it's true. A cheap premium today can turn into a budget bomb later. Now add the insurance whiplash. The federal flood program was reauthorized in November after a mess that stalled closings, but it's only funded through January 30th, 2026. That's a clock. Lenders hate clocks. If a program that backs most flood policies might hiccup again, underwriters get conservative, fast. Buyers hate surprise premiums. Both sides are staring at the same deadline, just from different chairs. It's like banning restaurant grades from the window and telling you to click a PDF while you're ordering raw oysters. Technically, the info exists. Practically, you're rolling the dice because the line behind you is moving and the bartender already swiped your card. That's what listing pages look like without surface-level risk cues. And the fallout isn't theoretical. Treasury's numbers showed people in high-loss zones are already paying much more for coverage. Premiums heavier, non-renewals higher. When carriers shrink their appetite, households feel it first, but lenders feel it next in debt-to-income math and forced-place policies that wreck monthly payments. Tight budgets meet tighter underwriting. The spreadsheet doesn't blink. So yes, the public-facing risk went dark on your favorite search app, but the risk didn't dissolve. It retreated behind the lender's firewall into dashboards you don't get to click. Better data, more property-specific, plugged straight into eligibility rules you only encounter when your pre-approval mysteriously shrinks. Here's the twist you actually care about. If the public map fades to grayscale, whose map decides whether your mortgage gets a green light? Not the one you can zoom on your phone. The one you never see, with your block outlined in a color that isn't meant for you. So why does a listing look squeaky clean while your lender quietly slaps a red stamp on the whole block? Because the consumer map is vibes. The lender map is engineering. They're not looking at pretty colors. They're running property diagnostics that read like a building autopsy. It's a private playbook, built for underwriting, not marketing, and it throws flags you'll never see. Here's the thing. Behind the scenes, lenders tap platforms that pull in topography and micro-elevation, not just near a bay. They read soil expansion and subsidence risk, not just nice lawn. They parse vegetation density and ladder fuels around the structure. They log roof type and age, fastening systems, and edge metal. They note foundation height in inches, flood vents in count and size, and whether you've got a 6-foot defensible space that actually clears brush. Then they drop hazard layers for flood, wildfire, and wind right on top. It's not a scare graphic. It's a blueprint for either approving your loan or ghosting it. And it translates straight to terms. A climate-adjusted value shaves dollars off what the model thinks your house is worth once hazard and insurance costs are priced in. A resilience rating grades how your build will perform when bad weather shows up on a Tuesday. Underwriters then attach conditions. Install vents, raise equipment, upgrade to Class A shingles, add ember-resistant screens, or no deal. They cut your loan to value, add reserves, or push you out of standard products altogether. You don't fail the map. The map just makes your mortgage more expensive until you fix the weak points. Concrete? Coastal floodplain first. If your finished floor sits well below the base flood elevation, the model sees a big delta and assumes deep water under certain storms. That can trigger a required elevation certificate, a mitigation plan, and an LTV haircut. In the wildland-urban interface in Northern California, a parcel with one skinny egress route, heavy vegetation, and wood vents is a bad combo. The fix list can be long. Hardened vents, metal roof edges, clear space, maybe even water supply upgrades. On the Gulf, aging roofs catch the new wind models like a net. If the fasteners and underlayment don't meet current standards, some desks treat that roof as a pre-existing loss waiting to happen. Translation: pay to re-roof, or pay in rate and points. Then there's the insurance choke point. If the federal flood program reforms again or stalls, private carriers push prices hard. Those 64% premium jumps you heard tossed around? Treat them as line items in your debt-to-income math. Underwriters do. A policy that moves from $2,500 to $4,100 doesn't feel theoretical when your DTI blows past the cap and the approval letter shrinks. It's real. It's happening. Zoom out to portfolio logic and it gets colder. Lenders model exposure by zip, by census block, and by loan pool. A cluster of properties with high flood depth or ember exposure won't just look risky individually. Together, they spike expected defaults after a storm, or when renewals arrive with eye-watering premiums. That pushes the whole area into tighter rules, even if your particular house has the best gutters on earth. Collateral is local, risk is pooled, and the market reacts. Buyers steer away from high-hazard streets. Listing velocity slows. Appraisers pull comps that sag under insurance drag. Values erode, which feeds the climate-adjusted models again. Underwriting tightens, again. It's a loop, and your budget is the rope.